Welcome back to Around the Table with Stacy Smith as we're talking about the investing and the economy. A few minutes ago, I was mentioning that the bear seems to be lurking, in my opinion, waiting to pounce. Point in fact, since setting their highs in July, the markets are all down. In fact, the NASDAQ and the S&P 500 have entered what they call correction territory, and the Dow is almost there. So, Michael, can you explain to us what is correction territory, and is it a harbinger of bad things to come?
Yeah, so the S&P 500 hit an all-time high back on January 3rd of 2022. And we all know what a rough year 2022 ended up being. But the first half of this year saw the stock market, as you mentioned, Stacy, do pretty well. Right through the first 7 months of 2023, the S&P 500 was up almost 20%. Still off those all-time highs set back in 2022, but still solid returns. And as you mentioned, the past 3 months since the end of July, the stock market has trended lower and is down about 10% over that time. And that's what a correction is. It's a decline of 10% in the stock market from its most recent highs. Now, I think the most important thing to note is that corrections happen far more often than most investors realize. Okay, I was looking at this data earlier. If you go back to 1980, that's 43 years of returns. The average intra-year drop in the stock market is about 14%. So in any given year, you can expect double-digit declines in the stock market. So when I'm thinking about this, in my mind, because these happen so frequently, and because historically the stock market has always recovered from a correction, an investor's reaction to their portfolios when a correction happens is of the utmost importance to their intermediate and probably their longer-term returns. Because often investors will just shoot themselves in the foot by selling stocks after a correction has already occurred. And thus, not only will they have captured that loss by selling at the wrong time, but they will often remain out of the markets after it has recovered. So I don't think this means that you just never do anything to your portfolio, Stacy. I think it's very important to make tweaks based on where you believe we are in the economic cycle. But making wholesale changes just because the market is in a rough patch often ends up being pretty detrimental to your longer run returns.
I think part of the reason we have this correction going on is the fact that long-term interest rates have started to rise. People have been forced over the last 10 or 20 years to take unnecessary risk in order to try to get a return. Now that we have higher, longer-term interest rates, it's possible to put money to work for 4 and 5 and 6% without taking outrageous risk, when that wasn't possible until recently. Therefore, I think what we've got is we've got a lot of money that earlier this year was moving to money market funds. Now it's moving into long bonds because they have sold off as well, and their yields are higher. And so you have the institutions leaving the bond market, and people are starting to leave the stock market to buy bonds because the dividends that are high, are not that safe. So to lock in rates of return with a piece of the money, I think, is creating a bit of a correction. And I just think it's a realignment to some more balanced portfolio for the average person, so that they're taking a risk, have a risk profile that's more in line with the risk they probably ought to be taking instead of the risk they have been taking.
Stacy, from an investment perspective, being able to discern why corrections happen and what investors should do is really one of the biggest values that we provide to our clients. And along the lines of what Michael said, corrections are normal, they're necessary. When we look at why corrections happen, I mean, in my opinion right now, the reason why we're seeing this correction is that I think the market got ahead of itself in light of interest rates. And, you know, as Michael has been preaching for as long as Michael's been doing this show, it takes a while for the consumer to really, truly feel the impact of higher interest rates. And when you listen to these earnings calls of these companies, they're concerned about the impact of higher interest rates, not only on their own businesses, but also on what this means for the consumer and what this means for housing, which is a multiplier, has like a 7 times multiplier on the economy. So we look at this as a short-term issue. You have to look beyond it and say, okay, well, what if we do go into a recession? Well, if we go into a recession, the Fed's going to lower interest rates. Everyone's going to be happy. I mean, these are cycles. We call them economic cycles for a reason, which is why, as Michael said, you don't want to be making wholesale changes just based on market volatility.
Michael,
Gary.
go ahead.
No, I just want to say thanks to Carrie for patting me on the back there, because I have been talking about interest rates and how long it takes to work its way through the economy. The one thing I do want to point out, but I don't want to get too technical on this, is what Frank brought up in regards to longer term bond yields. There's two things to maybe pay attention to this. One, the yield curve got pretty inverted for a while, meaning the yield on a 10-year bond was much lower than the yield you would get by buying a US government 2-year bond. Most inverted it had been in 30 years or so. That historically had signaled a recession would be on the horizon. Timing, you never know what that would be. But Frank mentioned that long-term bonds have come up quite a bit, meaning they're yielding a bit more. This is something that kind of concerns me as well, because as that curve uninverts and those longer-term bonds look a little bit more attractive from a yield standpoint, that is a little bit more concerning from an economic standpoint. So historically speaking, that means a recession could be happening sooner rather than later. And Frank also mentioned, last thing real quick, bonds do look a lot more attractive than stocks right now based on the earnings metrics of stocks and the yield of longer term bonds. So something else we're looking at too.
Well, I hope to delve into all of that in another segment that we'll do maybe in the future, but we have to take a break right now, and we'll be back in just a moment.